we're going to do a reasonably quick presentation because we know that you'll be sort of very market focused and leave a lot of time available for Q&A afterwards. So what I'm going to do is I'm just going to share with you my screen right now and go through a presentation which we sort of go through up and down the country. I'm going to go through it fairly quickly in this case because I just really want to focus on the stuff that you'll be interested in. So hold on for a second. Let me just get this down here. Play. There we go. Can you see that, Andrew? Just checking.
Yep, you're in.
All good. Okay, fantastic. Look, just a quick reminder, we're obviously a non-for-profit owned by a charity, and we do KiwiSaver investment funds and first home loans. We're now doing affordable housing, which I'll talk about in a minute. What that means is that our perspective is a very, very long-term one. So when we look at markets like this, we look at it with a very, very long lens. And just to let you know, our numbers do the talking is that these numbers are out of date now. We're almost 125,000 members. We're growing very quickly now. The funds under management has gone down again because the markets have gone down. The donations are now over $4 million, but obviously a sizable business now with real critical mass. Just want to talk about inflation, interest rates, and war right now. Every time we talk about these presentations, there seems to be some doom and gloom headline. Sometimes it's, making do in tough times or whatever, but there are things you can do. I think the first message here is, look, it's an unpredictable world, right? Can anyone remember back to 2019, that far ago? Since then, we've obviously had COVID, the Ukrainian invasion, inflation, supply chain problems, prices going up everywhere. And yet in that time, the US market went down 59% during the first wave of COVID, back up 16%, up 27% the next year, and so far down 15%, in fact, more like down 20%, because we're firmly in a bear market now. It's a very unpredictable world. Here is the chart that I always put up in every presentation, because I think that those who forget the lessons of history are doomed to repeat them. This is 122 years of the US share market. It shows that blue line there. It shows that it goes up and down with some really great moments. Well, not great, depressing moments, the Great Depression, the recession, the GFC, and coronavirus. And you would have seen that blue line now will be a little bit further down now. And those grey bars are the recessions that you have. And you can see a thin grey bar on the right-hand side where the recession is just arriving now. What's interesting about this chart is it's clearly a roller coaster, right? And the first rule of being on a roller coaster is you don't get off. But it trends up over time because obviously that's companies make more money, people want to improve their lives, they set up new companies. It's almost like a chart of human progress. In fact, in many ways, it's a metaphor for life, right? Things improve over time for most people, although it's a roller coaster journey on the way. The other thing looking at those grey bars is they happen infrequently. And in fact, we've had a big period of white just before this recession has arrived. So in hindsight, we've actually had a very good time of it with the financial markets, our post-GFC. The other interesting thing is, so why is the markets going down? Well, interest rates are clearly rising. This is the New Zealand 10-year bond yield chart since 1991. And as you can see, there's been a pretty sharp uptick in interest rates. It's not without precedent. If you can see plenty of times there, the actual interest rates have gone up. But it is quite surprising because the period from around about 2008 since then has been a pretty consistent period of interest rates trending down. And when they trend down, you reset your expectations. So our expectation was for them to go down and stay low for a long time. And interest rates have gone up because inflation's gone up. This is an inflation chart from 1990. And as you can see, there's been a big uptick in inflation, although it's not without precedent again. See all the times that it's bounced up in quite surprising amounts. So this is not unusual. Remember, those that forget the lessons of history are doomed to repeat them. It is not unusual to have inflation upticking quite sharply, although clearly this one is particularly dramatic. And the reason that inflation has gone up because costs have gone up. Here's the cost of shipping a container from the United States to China. As you can see, it went up dramatically over 10 times with COVID. And while it's gone down and continues to trend down, it's still significantly higher than it was. And also, one of the reasons for inflation is because governments have spent so much money on COVID relief. At least $9 trillion. The last number I saw was 12 trillion. And those blue bars show the percentage of GDP that they've put into the economy. And effectively what they've been doing, it's not the fancy terms for this, but effectively what they've done is printed the money, stuck it in the helicopter, dropped it on the economy. And, that finds its way into spending on things. particularly in COVID, when the factories stopped producing stuff, there's less stuff, and so more people are buying it with more money. And the other reason for inflation, of course, is war. The history of wars on the left-hand side there is they're inflationary, although inflation goes down when the wars stop. And Russia and Ukraine are major exporters of all those products on the right, all of which filter into the cost of our living. Obviously oil, natural gas, fertilizer, aluminium, steel, all of those things impact our daily cost of living. The other interesting thing, though, is even though there's all this inflation and war and stimulus and cost of living increases, it's interesting when you look back on inflation, because it went crazy. This is a chart from 1960. And as you can see, back in the 70s and 80s, inflation went pretty crazy, right? It got out of control, and central banks got sick of it. Politicians got sick of it and said, we want to bring it under control. And in New Zealand, we had the Reserve Bank Act of 1989, a very boring but very important piece of legislation. And all around the world, central banks were given the mandate of getting inflation under control. And look what they've done subsequently. Sometimes it pops up above the target range, and it certainly has now. Sometimes it's a little bit below. But by and large, if you look back in history, it's very, very controlled and constrained. And so I guess the message there is that the Reserve Bank has very blunt but very powerful weapons to get inflation under control. Probably not a good idea to bet against them long term. In fact, I'm reminded of this favorite quote. And so even though we don't know where the direction will go, we have no idea on where inflation will go, I am reminded of this quote from Mark Twain, which basically, so I'll let you read that. All right, so what he's effectively saying there is, be very careful of people who say that they absolutely know where the markets are going to go, because nobody knows for certain where they're going. And be very, very careful of people who say for certain this is going to happen, or this is absolutely the case, or whatever, because that's what gets you into trouble when you believe things. I'll give you an example. This time last year, a lot of people saying house prices will stay up forever. Inflation, interest rates will stay low forever. All of these people predicting things. It is a fool's game predicting the direction of financial markets. And so be very careful of people who tell you that they know what's going to happen. So you say, okay, well, Sam, you're not going to tell us where the market direction is going. We can see the inflation, see the interest rates. What can I do, though? Well, there's actually quite a lot you can do in times like this. First of all, just talking about the impact of inflation and interest rate rises. First of all, is they tend to be generally okay for shares prices and for house prices. And the reason is, with shares, companies can put up their prices so they can make more profit. And with homes, because the cost of living goes up, because inflation generally goes up, house prices tend to trend up as well. And then with fixed interest and government bonds, they tend to be a much more mixed bag. And in fact, a lot of our funds have gone down recently because the very high quality government bonds that we own, which will get repaid because they're investment grade bonds backed by the government and tax revenue and stuff, but they go down in value theoretically because the interest rate they're paying is uncompetitive relative to the interest rate you can get if you're a brand new investor now. So they go down in theoretical value, they get repaid and everything is okay long term, but they can suffer in an inflationary period in terms of their value. Inflation falls, still pretty good for shares and homes. Share prices go up because the dividends companies are paying look attractive relative to term deposits. And homes go up because the mortgage rates go down, so people might find it more affordable so that they can borrow more money, and that helps drive up house prices. Tends to be pretty good for fixed interest investments too, because new investments will be paying a lower rate of interest than current investments. So those current, the old investments you make are actually quite attractive, the interest rates. So in fact, if you look at that, in the last 10 years, inflation has been falling and it's been pretty good for investment markets. We've had a pretty good tailwind. The first trick is diversification. This is a chart, I show it nearly every time, which shows at the top, the best performing, and at the bottom, the worst performing asset class every year since 2012. And just pick a color, any color. As you can see, it's incredibly random. It's very hard to pick. In fact, it's a fool's game picking financial markets. So by diversification, what you're doing is you're actually buying winners. You own winners and losers, but overall you win because long-term the financial markets trend up. So look at any one of those years. You'll see even in the worst year, the best asset class has done well and the worst asset class has done poorly. Even in a really, really bearish year, you still get positive returns from the best performing asset classes. So as long as you own a lot of different investments, a lot of different places, there will be winners and losers. It doesn't mean that you will always win or always lose, but it does mean that at any one time, you're not going to be exposed to the dramatic losers. And in fact, the diversification means you'll benefit from the general trend of financial markets going up over time. The second thing you can do is still focus on fees. And I know we talk about this all the time, folks, but the reason that we set up Simplicity as a non-profit was so we could charge the lowest fee, because we knew that history tells us that fees are a massive drag on your ultimate wealth. Let's use an example. Using the current charges for these three things, this is what an average Kiwi pays over their lifetime. Using current mobile phone charges at the moment, average person would spend about $22,000 on mobile phone charges over their lifetime. By contrast, power bills are $36,000 for the average New Zealander. And look at this number, KiwiSaver fees. This is in a balanced fund on the average salary, someone saving for 45 years, with them contributing 3% and their employer contributing 3%. So it's a very average fee load. Now, if I told you that you would spend at current charging rates twice as much on KiwiSaver fees over your lifetime than a mobile phone, you'd be shocked, but that's what the numbers show. And so fees really matter. In fact, here is the Sorted website, which actually shows you the average fees charged versus our fees. So, for example, look at our growth fund. Our lifetime fees, this is down the bottom there, so a 20-year-old earning $50,000 a year, retiring at 65, 3% plus 3%, they would pay with us $18,000 in fees over their lifetime, but the average fee would be $71,000. That's huge. That's $53,000 that is gone out of your pockets purely on fee charges, assuming everyone's fees remain the same right now. If in the balance fund, we charge $14,000, average is $44,000. In the conservative fund, $11,000, average $33,000. So fees really matter. The other one is don't trade, but save. And I go back to my favorite chart again. And the reason I do that is when you see the markets going down, you naturally feel as if the money's been taken away from you, like it's been literally ripped out of your pockets, and you go, oh, I'm poorer. Well, you are in theory, the theoretical investments, but you're not actually going to crystallize that loss unless you actually sold the investments. So the negative way of thinking is, oh, my investments have gone down. But if you're a saver, you should welcome markets turning over the long term. You should welcome markets turning down, because effectively the same investments you bought last week have gone on sale, right? That's what Warren Buffett says, the world's most famous investor. He says, I rejoice when financial markets go down. The same investments I bought before are now on sale. That allows you to benefit from this amazing thing called dollar cost averaging. The thing you don't want to do is to make a decision out of fear and panic, because fear is a very powerful motivator. It's great when you want to save your life, but it's a terrible way in which to make financial decisions, and indeed many decisions in life, right? If you go through life and you think the decisions you made on fear, were they good ones or bad ones? Very often they're bad ones, and it's certainly the case with financial markets. So don't use this market downturn as to think, oh, freeze, take my money out, keep my capital safe. If you're in the right fund for you, and you sorted that out, you say the markets go down, that's great. If I'm regularly saving, I'm going to be buying more for my money. In that sense, don't think about investments as any different than a tin of baked beans. If you've got to buy one every week, if it goes on sale, you're happy. Yeah. I wanted to give you on this presentation, my own patented Get Rich Slowly scheme, because everyone will be feeling a little bit poorer right now. So I thought, all right, well, how do you get rich slowly? And nothing in life is guaranteed, but this is a pretty reliable way to do it. It's the way I do it with my own kids. Excuse me. So here's what I do. What you want to do with savings is you want to inflation index them, which means that you don't want to save the same amount of money over your whole life, because that amount of money gets to be worth less over time because inflation erodes it away. So you want to find a way of making sure that you're always saving enough, and that you're not letting inflation erode your savings. So here's what I do. I borrowed an idea from this guy, Albert Einstein. Now, he called compounding interest the eighth wonder of the world. So what can you learn from him in terms of how to get rich slowly? Well, here's what you do. If you save the price of a cup of coffee a day, and that's what I do with my kids, price of a cup of coffee a day, into a growth fund from the day they're born to the day they're 65, because the price of coffee will go up with inflation, you will be inflation indexing your contributions. So that means that you will make sure that you're always putting enough in and you're not putting in a false amount, because a lot of people will give you numbers pre-inflation and that artificially inflates how much you'll save. But if you could do with one less cup of coffee a day, and I certainly could, and you put it into your kid's savings account, this is what you would end up with by the time they're 25. This is in today's dollars, $81,000 by the time they're 25. Isn't that a fantastic house deposit? One cup of coffee a day. And if you kept them, oh, here's my savior. Jenny's bought me a glass of water. Thank you, Jenny. And if you saved that money and didn't use it on the house deposit till you were 65 for your retirement, you'd have $655,000 equivalent in today's dollars. Isn't that amazing? One cup of coffee a day using compound interest because you're in a growth fund. It's not, by the way, that's a growth fund that assumes those average crazy fees that I talked about before, and $71,000. With ours, it should theoretically be more, even more than that, because we charge lower fees. But that is the bona fide how to get rich slowly scheme. Unfortunately, I wouldn't patent it anyway, even if I could, because everyone should know. I just want to talk quickly about our housing crisis, because Simplicity is managing billions of dollars. And as a charity and a very long-term investor, we're thinking about how can we help with the housing crisis and make good returns for our members. It's probably in reverse order. How can we make good returns for our members while we're helping with the housing crisis? And we've decided to do it in three ways. The first is we announced Simplicity Living in September last year, and already now we've got our first 122 houses in build. We've bought the land for the first 600 homes, and we're already getting into it. There they are in construction down the bottom. They're built to last 100 years. We actually build them out of concrete and brick, and we build them to be very low maintenance, very long lasting, very quiet, very warm. And we're aiming for a carbon neutral form of construction. That's by waste minimisation and then planting native trees to offset those carbon emissions. We've already planted, I think, 122,000 via the Simplicity Foundation, and we'll plant more to offset the carbon created, particularly by the construction of concrete and steel. We want to get affordable long-term rents. These are all for long-term renting. And we think that we can get 1 to 2% above what we would get in the bank as a really long-term return rate, and at the same time provide affordable homes for people to rent. So members benefit, people renting the apartments benefit. And most importantly, it's a very secure cash flow. So even, there'll be other downturns like this right now. We don't want the money necessarily to be sitting all in government stock where the value in theory goes down and it spooks you and so on. We want it. It would be great if a bunch of it was sitting in the ownership and the renting of these apartments, so people just carry on paying their rents all the way through. So the idea here is to give warm, dry, secure homes and a great investment. So we're well on the way to doing that. The second one was to do the first home mortgages. You can see that orange line there. That's the rate at which we lend versus the black line, which is bank 1-year rates, the grey line bank 2-year rates, and the blue line, which is bank floating rates. And as you can see, we've been consistently lower than the market, because what we do is effectively we take some of the money that our members have saved in their funds. It's only a small amount, less than 5% always, and we lend that to other members with first home mortgages. First home mortgages are highly reliable. They're the safest form of lending that you can do, and we haven't had a single missed payment since we've started doing this. We now have over 100 million mortgages out there. And it saves our average member, we think, about $100 a week in interest, and it makes our other members, our KiwiSaver members and investment fund members who are funding these mortgages, it makes them more money too, because we take the profit that the banks would normally make, which is about 2%, and we give pretty much split it in half, 1% each. The third thing we're doing is funding community housing. This is to build social housing. This is debt which we provide that allows the houses to be built by community housing providers all over the country. And that debt is very, very safe. Andrew can go through the details on that as well. So very, very high likelihood of that getting repaid and allows social houses to be built. So those are the three things we're doing, which is absolutely fantastic. I would say also one other thing that is interesting, we've also invested now in about 62 startup companies in New Zealand by Rice House Ventures, and a couple of them directly. And they're really, you know, in many ways, these companies are the future of New Zealand. And it's awesome to be involved at a very early stage in getting them up and running. So is the future scary or cheery? You know, it looks pretty scary out there right now, right? But actually it's very cheery. Long term, we're very bullish on New Zealand. We think the next 30 years will be very prosperous indeed. And the reason is KiwiSaver, because so much money is being saved by New Zealanders, about 2.3% of GDP. That ends up to a fortune over time. It's already close to $100 billion. It'll be a little bit less now, but it's close enough to it. And the Treasury, who consistently underestimate these things, have said it could be 200 billion by 2030 and 900 billion by 2050. That's a huge amount of money being invested in New Zealand. It's a rising tide of money. You know, every single day, people are saving their KiwiSavers. It all comes in every single day. We have net new money to invest in Simplicity. And that means we can afford to do long-term projects like affordable housing, lending on mortgages and so on. And anywhere else around the world where people have started saving in their pension funds, they've, you know, the economy has shown amazing resilience. Australia has just had 26 years without a recession, even though it's a commodity country just like us, because its pension savings, which are now $3 trillion, have just continue to be recycled in the economy, creating jobs, building buildings, setting up companies, all that sort of stuff. Really good. So I'm going to pause right there. And Andrew, you're going to kick in as the question master. Let me just stop sharing here. Oh, have I stopped sharing there, Andrew?
I think so, yeah.
Yeah, good one. All righty. Over to you, mate.
Yeah, some good questions come in already. The first one I've got, which was from somebody anonymous, I'm going to have to look into. There's apparently a US Treasury product paying quite a high rate of interest, but there isn't anything similar in New Zealand. And I'm interested that the Americans would pay that amount even to their own investors. So I will look into that one. Yeah, I guess if you want to send a note through to our team, the email address, is info@simplicity.kiwi. If you want to send that question to them, I'll make sure they send it to me, and I will certainly answer it. Question from Jan is, she has one conservative KiwiSaver fund and one investment fund in balance. If she wants to start withdrawing for retirement, which one is the best one to start withdrawing from? That's a difficult one.
It is a difficult one, because the balance fund is going to be designed to last. It will make you more money over time in theory. The conservative fund, less money, but be a little bit safer. So it's actually hard. That's a hard question to answer. Sorry, it's an easy question to ask, hard question to answer. Do you have any view, Andrew? We can't give personalised advice, so.
Exactly, that's the difficulty, that people's personal circumstances are so difficult. In the recent past, and it feeds into a question I've got to answer in a minute, but the conservative fund has performed particularly badly relative to what we would expect over the long term, because it does have a lot of its investments in what are called fixed interest investments. But as Sam started to explain previously, because the value of those has gone down with interest rates rising, the conservative fund has, as I say, performed rather worse than expected. The balance fund's in between the growth and the conservative fund, but still it's been a particularly unpleasant sort of 6 to 9 months in financial markets anyway. I don't think there's an answer without knowing a little bit more about your personal circumstances. But as Sam says, that depending on exactly what age you are and how long you expect to be invested, the balanced fund should perform best over a longer period of time. So although it would feel particularly painful selling out of the conservative fund and capitalizing some of those losses, the balanced fund should be the one that is best. It's just so dependent on time. Any further thoughts, Sam? Or you?
No, that's absolutely fine.
And so following on from that, Jan's asked a couple of more questions about this. The conservative fund has suffered because interest rates have risen for the reasons Sam covered already. It's invested in lots of very safe, secure, long-term securities, but unfortunately, when interest rates rise and those securities are paying a lower rate of interest than is now the case, the value of those falls. And that has been a surprise from our point of view. We are investing for the very long term, so we hold those long-term investments. They have all moved now to an interest rate which is a lot more attractive than it was. So we'd like to think that they'll now stabilise, but right here, right now, we don't know for certain. We just know that over time, that will be the case. If you got anything you want to.
No, I think these things are theoretical losses in value. Remember, with these bonds that we buy them, the government's always going to repay them. I mean, they're investment. Well, you can never say absolutely, but all through history they've repaid these bonds, and so you're just getting a lower interest rate. That's all. But the impact of that lower interest rate has to be all condensed into the value of the price today. So it's not like you'll be losing your capital, you'll just be making less money over time. So it's a very hard thing to explain as sort of bond mathematics and the impact of interest rates on bonds. And it does confuse people, and quite rightly so, because they think I've got my money in a conservative fund and they think it almost like a term deposit. The investments are actually as safe, arguably safer than term deposits, because they're generally government and local authority backed bonds. But it does just mean that you have to wait until they get repaid in order to get all your capital back. So for a longer term investment, or someone just withdrawing a little bit over time, it'll be just fine. As spooky as it can seem to see the fund going down in the short term.
The last question there from Jan is to do with the returns you're seeing on your own overview compared to the published performance, and it's probably a question of time frame. Without knowing exactly, difficult to comment. But again, Jan, if you want to send a note through to info@simplicity.kiwi, I can probably answer specifically where you're at. I think we've answered that question in terms of bond investments, but if you want to flick up another question, if not, then please let us know. A question from Kim, would this be a good or bad time, given markets, to change from another KiwiSaver provider to Simplicity, or doesn't it matter?
Well, I don't think it matters either way, because remember, let's say, for example, and all KiwiSaver funds have gone down, so I assume they all have, so if they both go down, if you move at that point, then you may be getting out of your fund when it's a bit lower, but you're also getting into Simplicity when it's lower as well. So it sort of doesn't matter over time, and I don't think it would particularly matter now.
MB says, it's tough to avoid making predictions when we are regularly refixing mortgages with banks and trying to guess which rate trade-off is best. Do you think general economic predictions should be taken into account as part of these decisions?
Look, I'm not saying that that you should completely discount everything economists say. All I'm just saying is that generally the market is not reliable in making predictions. So relying on any one person's. So it's very difficult now, right? Because you think, well, people are saying interest rates are going up, they're going up further. Does that mean my mortgage will go up? Should I fix now? Bearing in mind that in these mortgage rates and interest rates, very often the information is processed very quickly by the banks and reflected in the rate that you're offered. So as a general rule, you're not going to outthink the banks. What I would do, this is just my personal, I'm not giving you personal advice, this is what I personally do, Andrew, in those sort of circumstances. What I think about is basically trying to smooth it out, maybe having a bet each way, so that psychologically you don't feel as if you've put all your eggs in one basket. And if it goes, interest rates move against you, that you feel, really, really put out as if you're paying too much. But, once again, it's a very personal thing. But I have generally found that psychologically what you feel like you're paying is just as important as what you're physically paying, because, the mortgage is a very, very, very big expense. And then if you have, some floating, some fixed, it means you can, try and try and pay down some of the floating if the rates go up a lot and you'll feel comfortable about holding the fixed, or or if you hold floating and the rates go down, you actually feel good about it, even though your fixed bit's a little bit more expensive. So it's a toughie.
Yeah, oh, absolutely. But as you say, I tend to try and have 2 or 3 different, my bank don't like it very much, but try and have 2 or 3 different tranches of my mortgage at different dates going forward, so that you're smoothing out those changes. But yeah, it's never an easy decision. Jan has also asked if I have savings in the bank, what do I do with them? Is a saving account with a bank better or worse than putting it in an investment fund?
Jan, very hard to know. It depends very much on your personal circumstances. If you want to have access to all of that capital all at once, well, you may not if you put it into a term deposit, but if you want to absolutely protect your capital and you're prepared to accept a lower return over time, then by all means put it in the bank. If you can accept situations like this where the theoretical value goes down, but over time you will make more money, then you should consider an investment funds, and you should go to Money Hub or our website or Sorted, and you could find out what fund is appropriate for you. But it depends very much about what headspace you're in, about how much you're prepared to accept the value of your investments being lower than they were, even though over time you will make more money. Can you handle being on that roller coaster? Yeah.
Absolutely. Now this would, I don't know whether you want to do this, or I'm happy to, Sam. Ronnie has asked, can we explain the concept of unit pricing? What goes into the unit price?
You go for it.
And how does bond value, for example, impact unit price?
Yep, go for it.
Over to me. So, Ronnie, a unit price, and it is quite a difficult, if you like, concept, but every single day, all of the holdings of the fund, let's call it the KiwiSaver Balance Fund, there is a value assigned to them, and it's because it holds a variety of shares, a variety of bonds. There's some cash in there, and those shares are spread all over the world. But there is a price fixed every single day that values every single one of its investments. And it's similarly, if one of the shares pays a dividend, that dividend's paid into the bank account, that increases the value of the investments. And every day we have people coming and going. We have a number of people that have, say, regular withdrawals out of funds, but similarly, particularly in KiwiSaver, we have lots of money coming in each day. And again, there's a registry which takes account exactly how many of those people, how much money has come into the fund. So the unit price is struck by dividing the number of people, which are the unit holders, and the number of units that they hold, dividing the total value of the fund by those unit holders. So if, for example, the holdings of bonds go down a little in value overnight, which is what we're talking about because interest rates have risen slightly, then the unit price will drop because that value has gone down. It's still divided by more or less number of units, but it's goes down very slightly to reflect the fact that the next day, if somebody were to either buy or sell that unit, they need to do that at the current value of the investments. It's, as I say, it's not the easiest concept to explain or understand. I hope that helps. Sam, have you got any further thoughts?
No, I just saying it's quite mathematical, but it's very thorough. It's checked very regularly. It's obviously designed to be absolutely fair to all people involved, and it does allow you to get in and out of funds very quickly without us having to individually share. So, we have 3,000 investments on your behalf in our growth, balanced and conservative funds. We couldn't possibly go and buy and sell 3,000 investments, overnight because you wanted your money back. The unitization allows us to do that very efficiently and at no cost to you, which is very good.
Jan's asked, could we come and build in Tasman or Nelson, please?
Yeah, Jan, I get asked that all the time. Can let us start in Auckland first, and we'll just migrate south as we get scale. So can't make any promises there, but any excuse to get to your part of the world, yeah, for sure.
Couple of questions here from Mike. The second one is the easiest one to answer because I know you know this one off the top of your head, Sam. So looking at our slides on the amount of GDP, percentage of GDP put into the market by all these different countries.
Yeah.
Japan's at the top, and the bottom's about 5. Where are we?
We're around about 20 to 25% of GDP. I can't remember the exact number, but we're sort of in the middle of the pack. Yeah.
The other question Mike asks, which is one I don't know the answer to, but have you read Tony Robbins?
Yeah. So this is about the book called Money Master the Game by Tony Robbins, where basically what Tony Robbins recommends is pretty much what Simplicity does. And so to answer your question there, Mike, we do pretty much align our investment philosophy with what he says and with what Warren Buffett says and with what Standard & Poor's data indicates, and with where I think it must be almost the majority of money in the world through pension funds is now managed, which is in low-cost index passive funds. That's what we do, absolutely.
Great. A question from Stephanie, which unfortunately we'll have to give our standard answer, but I'll ask it anyway. My KiwiSaver is in a balanced fund. If I wanted to retire in 5 years, am I in the correct fund?
So, Stephanie, I would go to our website or Money Hub or Sorted, go through the fund finder questionnaire there, and it will pop out the fund that would be appropriate for you.
I'll come back to that anonymous one in a second, because I know we'll want to cover that off in a bit of detail. A question from Brent: do we have any advice on what to do with cash that you need in about 18 months? I mean, 18 months is well below the minimum time frame that we would suggest is any of our investments. Outside of that, I'm loath to really recommend anything.
Yeah.
Anything you
can't give personal advice, Brent, but what I would do is stick it in the bank if it's 18 months, right, Andrew? Like, you know,
yeah.
Just who knows what markets will do in that time.
And then the second question from Brent is: what would you advise for the maximum length of term for a term deposit, given interest rates will probably carry on increasing? Yeah, that's a good question. But
yeah,
any
that
thoughts?
involves us predicting the future there, and we don't know.
So, no. I think, and I've said already, certainly interest rates have risen to a point that you feel you're getting a little more compensated for investing for the longer term now than you have been for a very long time. But whether they go up or down from here, unfortunately, we're not in a position to say comfortably. Another question from Mike: does Simplicity offer a managed fund investment portfolio exactly equivalent in terms of investments to the KiwiSaver options? I realise that the government and employee contributions are not included, but was wanting flexibility in withdrawal. Yeah, so Mike, yes, we do. If you go onto our website, simplicity.kiwi, there's an investment fund option there, which is exactly the same funds as our KiwiSaver funds, but not locked in. So the application process is a tiny bit different, and unfortunately, even if you've got your KiwiSaver with us, you still have to go through it. But we've made it as easy as we possibly can. And so finally coming to this one, Sam, which I know is front of mind for you at the moment, is: can you tell us more about the GIB board Simplicity sourced overseas? How are these different to the local product? Are they better? What about quality control? And as for very quiet apartments, how do you measure the noise levels?
Yeah, sure. So the GIB we're importing is from what's called Thai Gypsum, which is actually owned by the French company Saint-Gobain. It's a very high quality 100% gypsum board. It's very hard to know how it compares versus GIB, because GIB won't produce the testing results. They consider that to be their intellectual property, even though other plasterboard providers do produce their testing results. In fact, we have them for these boards that we have. We think it is higher quality. We certainly know it is certainly not lesser quality, but it may well be higher quality. It looks and feels like higher quality when you hold it in your hands. And it is certainly done to a very high quality standard internationally. In fact, it's built to the US standards for gypsum wood. When if you imagine the US, they have much more variation in temperatures and so on and stress in their buildings. So it's actually built for that. It's built to what we consider to be a higher standard. In terms of noise in the quiet apartments, well, the reason you have that is quiet apartments, if you have concrete and then brick, and you have basically concrete roofs and concrete walls, nothing substitutes for mass when it comes to noise reduction. There's a tremendous amount of mass in our buildings. And then we do measure the noise. There is a noise meters, and you get in the apartment next door, and you do things like jump up and down, scream, and so on. You see what the outside ambient noise is through the windows. We have obviously double glazed windows filled with xenon gas, so they are very quiet. In fact, you couldn't really have our apartments without them being extremely quiet. So that works. I'm not aware of any complaints about in the NZ living apartments in terms of noise.
Great. Now, a question on the chat here from David. You talk about the effect of inflation on investment returns. What can you tell us about the impact of the war in Ukraine while it's in progress and once it eventually concludes?
Yeah. Well, those who forget the lessons of history are doomed to repeat them, right? So history tells us that war is inflationary because governments spend money to buy weapons, support their economies, all that sort of thing in times of uncertainty. It also tells us that once wars end, the pressure on inflation goes down. So if history repeats itself here, we have more pressure on inflation because of the war in Ukraine. Once that stops or settles down or calms down or whatever it does, then the inflationary pressures will ease somewhat. So let's wait and see. There's no particular reason to be betting against history on this one, but we will have to wait and see.
Right. Thanks, Sam. Well, that actually brings us to the end of questions that we currently have. We're happy to sort of answer any more that anybody has. If you've got one burning, then please chuck it in the chat or on the Q&A. Thanks for your acknowledgement, Mike. There we go. There's one.
So what about
earthquakes?
Yes, they meet all current earthquake standards. Brick and concrete are actually not. As long as you spend the money, you can get them to be as earthquake proof as timber buildings. Yeah.
Great. So please ask away if you've got any more questions.
Otherwise, folks, I'm sorry, I'm going to have to race off because we've got some other things to do. Is a recording available? Yes, it is available on FaceTime, Andrew, yeah?
Yes, we've been recording this, so it'll be on our Facebook page and I believe on our YouTube page.
Yeah. Cool.
Great. All right, well, everybody, thank you very much for your attendance.
We'll see you again soon.
Yeah, absolutely.
Okay.
Thanks again.
Thanks, folks. See ya.
Cheers for now.